Inflation is good for gold. I've been talking about this paradox for years now because the markets don't get it. When the markets see hotter than expected inflation, what the traders believe is, the Fed's going to have to fight harder to win the inflation war. And that means higher for longer, not as many cuts, a tighter Fed. That's good for the dollar. That's bad for gold.
The truth about inflation and gold. They don't want you to know. Welcome back. In this video, Peter Schiff exposes the hidden realities behind rising inflation trends and the gold inflation puzzle. Discover the shocking connection between inflation and gold and why it could redefine your financial strategy. This is the insight you've been waiting for. Stay tuned to secure your edge in today's economy.
So anyway, we got massive deficit news that, the mainstream media is glossing over this. And if you're going to be looking at these inflation numbers, how could you look at the numbers and ignore this elephant in the room, which is a harbinger of much higher inflation? But let me just get to the actual numbers. So the first one that we got on Wednesday was the CPI. And the CPI was actually the better of the numbers as far as expectations, right? It wasn't really worse than expected. It was as expected, which was bad, right? So the consensus was for an increase of 0.3 in November, and we rose by 0.3. And that was higher than the 0.2 from October. Year over year, CPI was up 2.7, higher than the 2.6 year over year the prior month. So we're going in the wrong direction. Core, ex food and energy, up 0.3 on the month. Again, another 0.3. We've been there for like the last 4 or 5 months in a row, I think. And the year over year core was also up 3.3. We've been stuck at around 3.2, 3.3 for month after month after month. Nowhere near 2%. How Powell can look at these numbers and conclude that we're on a glide path to 2%, it's beyond me. You can't. All these numbers confirm is that inflation is bottoming out and is headed much higher. And it never got anywhere near 2%, especially if you look at the PPI, Producer Price Index, which is a leading indicator for the CPI, because generally the businesses have their prices go up first, and then they pass it on to the consumer second. So the PPI is more forward-looking than the CPI. And there, the numbers were really bad. So the expectation for the increase in November producer prices was 0.3, and we got an increase of 0.4. And that was double the increase from the prior month of 0.2. So we're really heading in the wrong direction fast. On the year over year, producer prices was supposed to be 2.6. It's 3%. We got a 3 handle now, not a 2 handle. Last month, the year over year PPI was 2.2%. Now it's 3. Now, I've been saying this on my podcast that the year over year numbers are going to start to get a lot worse due to the comparisons. And that's what's happening. So now we have a 3 handle. How long before we have a 4 handle? Not long. Look at the ex food and energy. There, it was a little bit better, actually, because it was only up 0.2, which was the consensus, right? So, and that was a little bit less than the 0.3. But the year over year core was supposed to be up 3.2. It was up 3.4. That was much higher than the 3.1 year over year from the month before. So the Fed wants 2% core. We're at 3.4 and headed in the wrong direction. Yet the Fed is going to cut rates by another 25 basis points. By the way, the ECB cut rates 25 basis points this week, and the Swiss National Bank went for the supersize 50 basis point cut. They cut in half. I think they went from 1% to 0.5%, right? Inflation is going to rear its head in a big way all over the world. The Eurozone, Japan, all these countries that are cutting rates should not be cutting rates. Inflation is going to roar back stronger than ever, right? Worse than what we had in 2001, 2002. That's what's coming. Ex food and energy year over year was 3.5. So these are strong numbers. Now, on top of that, adding insult to injury were the import-export prices that came out this morning. They were looking for a drop of 0.3 in import prices. Instead, we got a rise of 0.1. And year over year, they were looking for an increase of 1. We got an increase of 1.3. On the export prices, they were looking for a drop of 0.1, and we were unchanged. And the year over year export prices are up 0.8. The month before, they were down 0.1. So again, we are moving sharply in the wrong direction. Inflation is getting worse as the Fed is pouring gasoline on the fire. Now, there are a lot of people that think, well, because of this inflation, maybe they're not going to cut as much in 2025. That's one of the reasons that you're getting this strength of the dollar. You got a big drop in gold the last few days. Gold's about $50 an ounce lower than it was when I did the podcast on Wednesday. It was at 2,700, basically just below. In fact, it went to 2,717 or so after that. It had a little rally. It almost got, almost got close to new highs. And then these bad inflation numbers clobbered it. And now gold is back to 2,650. But inflation is good for gold. I've been talking about this paradox for years now because the markets don't get it. When the markets see hotter than expected inflation, what the traders believe is, the Fed's going to have to fight harder to win the inflation war. And that means higher for longer, not as many cuts, a tighter Fed. That's good for the dollar. That's bad for gold. They're wrong. What higher than expected inflation means is that the Fed already lost the war on inflation. It's not going to fight harder. In fact, it's going to surrender. Inflation won. It just hasn't admitted that yet. It's still pretending. The Fed is still pretending that it won. It didn't even come close to winning. It's already surrendered. The markets just haven't figured that out yet. But at some point, they're going to realize that that white flag has been waving, and that is bullish for gold. Higher inflation is always bullish for gold, especially when the Fed can't do anything about it. Their hands are tied behind their backs. In fact, before too long, probably during the Trump administration, the Fed is going to have to fess up and say that it's willing to accept higher inflation, that's just the price we have to pay to stimulate the economy, to deal with the debt, to whatever. It's going to come up with an excuse. I don't know if it's going to raise its official target to 3 or whatever it's going to do, but it is going to be cutting rates. It is going to be doing quantitative easing, even as the inflation numbers move further and further north of 2%. And in fact, we got numbers on Thursday for jobless claims that unexpectedly shot up from 225,000 last month to 242,000. Last week to 242,000 and in the last week. And the 4-week moving average jumped up from 218.50 to 224.25. This is the highest number of claims we've had in a while. And again, could be the beginning of a big trend on increasing unemployment. And so, the economy is weak. Again, the weak economy is the reason that Trump was elected. And that weak economy that got Trump into office is going to continue while he is in office.
Thank you for watching. If this video opened your eyes to the realities of inflation and gold, don't forget to like, share, subscribe, and press the bell icon for more insights from Peter Schiff. Let us know your thoughts in the comments. How are you preparing for the financial challenges ahead? Stay informed, stay prepared, and we'll see you in the next video. ***.